The first domino didn't fall on Wall Street. It fell inside your wallet. You just didn't notice it yet. Maybe it was the moment you opened your mortgage statement and the number was higher than last year. Maybe it was the credit card bill that suddenly felt heavier, even though you didn't spend more. Maybe it was the grocery receipt that made you stop and stare. It was the car loan offer you couldn't believe. Maybe it was your retirement account quietly going sideways while everything around you got more expensive. Most people think a debt crisis is something that happens on television, something far away, something that belongs to politicians, traders, and economists in suits. But that is not how this works. A debt crisis does not begin with a crash. It does not begin with breaking news. It begins quietly, almost invisibly, inside the financial life of ordinary people. It begins the moment money becomes more expensive. And once that happens, everything connected to money begins to change. Your loans, your job, your savings, your investments, your purchasing power, your future. The truth is simple and uncomfortable. By the time the headlines admit there is a problem, the problem is already inside your house. And tonight, I want to show you exactly how it gets in. Step by step, in plain English, without panic, without jargon, without pretending I can predict the future. Because the people who understand the mechanics of a debt crisis are not the ones who panic. They are the ones who prepare. Before we go deeper, if this kind of analysis is what you've been looking for, do me one small favor. Hit that subscribe button. It costs you nothing. And it helps this channel reach more people who deserve to understand what's actually happening to their money. Now let's get into it. Here is the part most people get wrong. They think a debt crisis looks like a movie. A trading floor in chaos. A president on television. A bank with a line outside the door. That kind of crisis exists, but it is almost always the final scene, not the first one. The real beginning is quiet. It begins when the government has to pay more to borrow. Then banks have to pay more to lend. Then companies have to pay more to operate. Then families have to pay more to live. And then, slowly, almost politely, the cost of everything starts to rise, while the value of your paycheck starts to shrink. There is a sentence I want you to remember for the rest of this video. A debt crisis starts in the bond market, but it ends at the kitchen table. That is not poetry, that is mechanics. Because the bond market is not some abstract place. It is the place where the price of money is decided. And the price of money decides almost everything else in your financial life. Your mortgage, your car loan, your credit card APR, your business line of credit, the interest you earn on your savings, the valuation of the stocks in your retirement account, even the willingness of your employer to keep hiring, expanding, and paying bonuses. When the price of money changes, every single one of those things changes with it. And that is why this story is not about Washington, it is about you. Let me give you an analogy, a simple one. The kind you can explain to anyone at dinner tonight. Imagine a family. They earn a good income. They have a strong reputation in their neighborhood. For years, every bank in town has been happy to lend to them. They never had to think twice about credit. They could borrow at low rates, refinance whenever they wanted, and always count on someone showing up with an offer. But there is a quiet problem inside this family. Every single month, they spend more than they earn. Not by a little, by a lot. And instead of fixing the gap, they cover it by borrowing. At first, nobody cares. The family looks rich. The house is big, the cars are new, the reputation is intact, the lenders keep showing up, but years pass, the debt grows. And one day, the lenders start to notice something uncomfortable. This family is no longer borrowing to build a better future. They are borrowing just to pay the interest on the debt they already have. That is the moment trust begins to crack. Lenders do not walk away, they just start asking for more. Higher interest. Stricter terms. More guarantees. And suddenly, the family that used to borrow cheaply is now borrowing expensively. Every new loan costs more than the last one. Every refinance hurts a little more. The income did not fall. The lifestyle did not change. But the cost of being this family just went up. Now scale that family up to the size of the largest economy on the planet. That is the United States government. When trust is high, borrowing is cheap. When trust weakens, borrowing gets expensive. And when borrowing gets expensive for the government, it gets expensive for everyone living inside the economy that government runs. That is not a political statement, that is arithmetic. So how does this actually reach you? This is the part nobody explains clearly. They throw words at you: yields, spreads, liquidity, duration, and your eyes glaze over. But the mechanism itself is simple. Let me walk you through it slowly. This is what economists call the transmission mechanism. I just call it the path the pain takes to get to your bank account. It starts here. The United States government spends more than it collects in taxes. To cover the gap, it sells debt. That debt is called a treasury. When you hear the phrase 10-year yield, that is just the interest rate the government has to pay to convince someone to lend it money for 10 years. Now, when the government needs to sell more and more debt every year, and buyers start to feel nervous about how much is being issued, those buyers do something very rational. They demand a higher interest rate to take the risk. That higher interest rate is the yield going up. Here is the part that matters for you. The 10-year Treasury yield is not just a number for traders. It is the baseline price of money in the entire economy. Almost every other interest rate in the country is built on top of it. Mortgage rates sit on top of it. Car loan rates sit on top of it. Corporate borrowing rates sit on top of it. Credit card rates feel it. Student loan rates feel it. Even the rate your small business pays on a line of credit feels it. So when the Treasury yield rises, it does not stay in Washington. It travels. It travels into your mortgage application. It travels into your auto loan quote. It travels into the rate your employer pays to refinance their corporate debt. And when your employer suddenly has to pay millions more in interest, something has to give. Hiring slows down. Bonuses get smaller. Expansion gets postponed. Sometimes jobs get cut. Meanwhile, families with adjustable debt feel it directly. Their minimum payments go up. The money they used to spend at restaurants, on vacations, on home improvements, on their kids, that money now goes to interest. Spending slows. The economy slows. Profits slow. Stocks reprice. Retirement accounts feel it. This is how a government debt problem becomes a household cash flow problem. It does not need a crash. It does not need a panic. It just needs time. And the higher the cost of money stays, the deeper the damage spreads. Quick pause. If this is starting to make sense, if you are finally seeing the connection between what happens in Washington and what happens in your wallet, do two things for me. Drop a comment below with the word connected. It tells me you're following. And hit that like button. It genuinely helps this video reach people who still think this stuff doesn't apply to them. Now let's talk about where this actually hits you first. Because the impact is not random. It follows a pattern. Once you see the pattern, you cannot unsee it. There are 3 places your money gets hit first. 3 doors the crisis walks through before it touches anything else. If you understand these 3 doors, you understand the early stages of every modern debt cycle. The first door is debt. Not all debt is equal. Some debt has a fixed interest rate, locked in years ago, and that debt is relatively safe in the short term. But a huge amount of debt in this country is variable, floating, adjustable, tied directly to short-term rates or to the cost of refinancing. Think about who that hits. Credit card balances reprice almost immediately. The average American carries thousands of dollars on cards that now charge punishing rates. Adjustable mortgages reset. New car loans are written at the new, higher rate, which is why monthly payments have quietly become unaffordable for huge portions of the population. Student loans on variable structures feel it. Small business loans feel it. Lines of credit feel it. Home equity lines feel it. If you owe money at a floating rate, the first domino already fell on you. You may just not have done the math yet. The second door is income. This one is sneakier because it does not show up on a statement. It shows up in the things that quietly do not happen. When companies face higher borrowing costs, they go into protection mode. They stop expanding. They stop hiring. They delay projects. They cut overtime. They reduce bonuses. They freeze raises. They renegotiate vendor contracts. And eventually, if the pressure lasts long enough, they cut jobs. You may not lose your job, but the raise you were counting on does not come. The promotion gets postponed. The bonus shrinks. The side project gets canceled. The new position you were going to apply for never gets posted. That is income compression. And it is happening across entire industries right now, quietly, while most people are still focused on the headline unemployment number. The third door is assets. This is the one most investors are blind to. A lot of the wealth created over the last 15 years was built on top of cheap money. Cheap money lifts almost everything: growth stocks, real estate, long-duration bonds, private companies, crypto, speculative bets of every kind. When money is cheap, the future is worth a fortune, because investors are willing to wait for it. But when the cost of money rises, the future gets discounted harder. Assets that depended on cheap money get repriced, sometimes brutally. That does not mean every asset crashes. It means the rules of the game change. The things that worked in the era of cheap money are not the same things that work in the era of expensive money. And most portfolios have not adjusted yet. Debt, income, assets, 3 doors. The crisis walks through at least one of them in every household. The question is not whether it touches you. The question is which door it walks through first. Now here is the part of the story almost nobody wants to say out loud. When governments and central banks face a serious debt problem, they have a limited menu of options. They can cut spending, which is politically painful. They can raise taxes, which is also politically painful. They can default, which is unthinkable for a reserve currency. Or they can do something quieter, something more polite, something that does not require a vote. They can let inflation do the work. This is what people mean when they talk about the quiet tax. Inflation is a tax you never voted for. It does not show up on your pay stub. It does not get debated in Congress. It does not arrive in the mail with a return address. But every single month, it takes a little piece of your money, and it never gives it back. Here is how it works in practice. When the system gets stressed, when banks are wobbling, when liquidity dries up, when the cost of money spikes too fast, somebody usually steps in to rescue the situation. More liquidity gets injected. Credit conditions get eased. New programs get announced. The headlines get calmer. The market gets relieved. And for a moment, it feels like the problem is solved. But the problem is not solved. The problem is transferred. Because every rescue has a cost. And that cost rarely lands on the people who cause the stress. It lands on the people who hold the currency. It lands on savers. It lands on workers who are paid in dollars. It lands on retirees living on fixed income. It lands on families whose paychecks do not adjust as fast as prices do. When the system gets rescued, the bill doesn't disappear. It changes address. That is why so many people feel poorer even though they are still working. Even though they got a raise. Even though the unemployment rate looks fine on paper. Because the unit they are paid in, the dollar, is quietly losing ground against the things they actually need to live: food, housing, energy, insurance, healthcare, education. You can be employed, productive, responsible, and still be falling behind. Not because you are doing something wrong. Because the math of the system is moving against you. This is the part of the debt crisis that does not look like a crisis at all. It looks like life just getting harder, year after year, for reasons no one can quite name. And once you understand this, something starts to change inside you. You stop asking why everything feels expensive. You start asking what holds its value when the currency does not. That is the next part of this story. When people sense that the rules of money are shifting, they start to behave differently, quietly, without announcing it, without putting it on social media. They start looking for protection. You see it in the data before you see it in the news. Demand for physical gold rises. Demand for silver rises. Central banks around the world stop selling gold and start buying it again, at the fastest pace in decades. Families that used to keep everything in a checking account start asking questions they never asked before. What is a treasury bill? How do I hold something outside the banking system? What is a real asset? What is a hard asset? What does it actually mean to diversify? This is not panic. This is pattern recognition. Because every generation eventually learns the same lesson. When trust in promises falls, people look for things that do not require a promise. A dollar is a promise. A bond is a promise. A pension is a promise. A bank deposit is a promise. A digital balance on a screen is a promise. None of those things are bad. They are useful. They are part of a functioning system. But they all share one feature. Their value depends on someone else honoring their word. Gold does not depend on a promise. Silver does not depend on a promise. A productive piece of land does not depend on a promise. A profitable business you actually control does not depend on a promise. Skills do not depend on a promise. None of these are perfect. All of them have trade-offs. But they share something the financial system cannot offer, which is that they exist, whether or not anyone keeps their word. I am not telling you to buy any of these things. I am not your financial advisor. I do not know your situation. What I am telling you is that the psychology behind the move toward protection is rational, ancient, and predictable. Every time the cost of money shifts violently, people rediscover the value of things that cannot be printed. And the smart ones do it early, before the headlines, before the panic, before the crowd shows up. Which brings us to the most useful part of this entire video. If you can see this coming, even partially, you stop reacting and you start preparing. So let me give you something practical. A short list of things smart people watch before everyone else panics. You do not need a finance degree to follow these. You just need to know what they mean. The first thing to watch is the 10-year Treasury yield. This is the heartbeat of the entire credit system. When it rises fast, the cost of money is rising for everyone. When it spikes, something is breaking somewhere. The second thing is mortgage rates. They follow Treasury yields, but with their own personality. They tell you whether housing, the biggest asset class for most American families, is getting more affordable or less affordable in real time. The third thing is credit spreads. That sounds technical, but it is simple. It is the extra interest that risky borrowers have to pay compared to the government. When that gap widens, the market is telling you it sees more risk. When it widens fast, the market is screaming. The fourth thing is Treasury auctions. Every few weeks, the government tries to sell new debt. If those auctions go smoothly, the system is calm. If they go badly, if buyers demand much higher yields, if the auction has to be rescued, that is a warning shot. The fifth thing is dollar liquidity stress. You will not see this on cable news, but you can feel it through indicators like short-term funding rates and the behavior of the Federal Reserve's emergency tools, including swap lines with other central banks. When the plumbing of the dollar system creaks, everything else eventually creaks too. The sixth thing is the behavior of gold and silver, not the daily noise. The trend. When real assets quietly grind higher while central banks accumulate them, the market is telling you something about confidence in paper promises. The seventh thing is unemployment claims, not the monthly headline number, the weekly claims data. It is one of the earliest signals that companies are starting to protect cash by cutting people. The eighth thing is corporate refinancing stress. Trillions of dollars of corporate debt have to be refinanced over the next few years. Watch the headlines about layoffs, asset sales, dividend cuts, and emergency capital raises. Those are not random business stories. They are symptoms. You do not need to track all of these every day. You just need to know they exist. Because the moment 2 or 3 of them start flashing at the same time, you are no longer in a normal market. You are in a transition. And in a transition, the people who already understand the map move first. So let me bring all of this back to where we started. The first domino was never the crash. It was never the headline. It was never the moment of panic on television. The first domino was something much quieter, much earlier, and much more important. The first domino was the moment the cost of money changed. Everything else you are going to see in the coming years, whether it is housing pressure, layoffs in industries that looked untouchable, retirement accounts that refused to grow the way they used to, small businesses quietly closing their doors, families restructuring their lives around higher payments on the same old debts, all of that is downstream of one simple shift. Money got more expensive. And a system built on cheap money cannot pretend forever that nothing has changed. This is not a prediction of collapse. I am not here to tell you the world is ending. The American economy is enormous, resilient, full of brilliant people and powerful companies, and it has survived crises before. It will survive this transition too. But surviving as a country is not the same as surviving as a household. Those are two completely different conversations. A country can absorb decades of damage and still call itself strong. A family cannot. A retiree cannot. A worker living paycheck to paycheck cannot. A small business with a maturing loan cannot. The macro story and the personal story do not move on the same timeline. And that is exactly why understanding this matters. Because the point of this video was never to scare you. The point was to stop you from being surprised. Surprise is the most expensive emotion in finance. It is the reason people sell at the bottom. The reason they buy at the top. The reason they freeze when they should move and move when they should wait. Almost every bad financial decision in history was made by someone who did not see something coming and reacted out of fear. You do not have to be that person. You do not need to predict the exact day, the exact event, the exact number. You just need to understand the direction the system is moving in, and the doors through which it touches your life. Debt, income, assets, purchasing, power, trust. Those are the channels. Now you know how to watch them. The people who get through transitions like this are almost never the ones with the most money. They are the ones with the most clarity. They see the mechanics. They respect the math. They stop arguing with reality. They adjust early, calmly, without drama, while everyone around them is still waiting for someone on television to tell them what to do. You just spent 14 minutes getting ahead of that crowd. Do not waste it. Look at your own situation honestly. Look at your debt. Look at the rates you are paying. Look at where your income actually comes from, and how fragile or resilient it really is. Look at what you own, and ask yourself a simple question. If the cost of money stays high for years, does this still work? If inflation keeps quietly eating at the dollar, does this still protect me? If the rules of the last cycle do not apply to the next one, am I prepared? You do not have to answer those questions today, but you have to start asking them, because the first domino already fell. The only question now is whether you see the next ones coming, or whether you find out about them the same way most people do. By opening a bill, a statement, or a piece of bad news, and wondering how it got so close to home without anyone warning them. You were warned, calmly, clearly, without panic. That is the most valuable thing this channel can give you. Now I want to hear from you. Where do you think this hits first? Is it housing? Is it jobs? Is it inflation eating away at everyday life? Is it the stock market and retirement accounts? Drop your answer in the comments. I read them. And the conversation under these videos is often more valuable than the video itself. Because real people share what they are actually seeing in their own lives, in their own cities, in their own industries. If this video helped you understand something you have been feeling but could not name, hit that like button. It sounds small, but it is the single biggest thing you can do to help this kind of analysis reach more people who deserve to hear it, instead of the noise they get everywhere else. And share it with someone in your life who still believes that government debt has nothing to do with their personal finances. They will thank you later, even if they argue with you today. And before you go, there is another video on your screen right now that goes even deeper into the next phase of this story. Today's video showed you how the first domino reaches your wallet. That one shows you what tends to happen next, and how to position yourself before the rest of the crowd catches on. Click it. Watch it now, while this is still fresh in your mind. The system is not going to send you a warning letter. Nobody is going to knock on your door and tell you the rules just changed. But you are early. You are awake. You are paying attention. That is already worth more than most people will ever realize. I'll see you in the next one.